the Dubai real estate market is about to crash. At least that's what you're led to believe. Bloomberg, UBS, Fitch, report after report, they're warning us about the correction. So it's time to show you all the relevant data points. And some of them, they're not just surprising. They will make the reports by big names look silly. Let's start with what the global media says. And they have two different narratives that come to the same conclusion that Dubai is a bubble. The first one is led by UBS. UBS is a global investment bank, and every year they publish a bubble index report, which is basically their assessment of the bubble risks for different real estate markets around the world. And in the report they published this year, Dubai has a higher bubble risk compared to the previous years. The main issue with this report is that their methodology isn't transparent. If you're a critical thinker, it's really hard for you to challenge their ideas, because you don't understand their assumptions. And this is the problem with many indexes. Many of them are pretty BS. The second narrative is led by Fitch. Fitch is a global rating agency, and 6 months ago they published a report which basically said that Dubai will be oversupplied. They were predicting 210,000 units to be delivered in 2025 and 2026. These units will likely flood the market, and according to them, this will lead to oversupply and price correction of up to 15%. This report was picked up by global media, and then pretty reputable agencies published many articles about Dubai being a bubble and heading towards a price correction. And my opinion is that all of them are wrong. But who the hell am I to argue with such reputable experts? I'm Jay. I run a real estate advisory and brokerage firm in Dubai. So this is the moment when you go to the comment section and leave a comment that I'm biased. But before starting my own firm, I was a banker, and before that I was a management consultant at BCG. So I know firsthand how these reports are made. And let me show you two articles by Bloomberg. Dubai left behind as world's prime property hotspots thrive. The burst of supply will probably leave Dubai to witness a decline in values for their top-end residential properties. And another one. Dubai real estate market may bottom up next year, S&P says. S&P is a global rating agency company, kinda similar to Fitch. We already had a supply and demand imbalance in the market even before the pandemic, and after COVID-19 the situation just got worse. Funnily enough, these are not recent articles. They were published by Bloomberg in 2021, right before Dubai real estate market experienced the crazy fast growth. The average value growth for apartments in Dubai since 2021 to 2025 was around 50%. So yeah, I feel pretty confident arguing with these guys. And if you want to get the report that shows you the full picture, get the bubble report by Forever Estates. Scan the QR code that is right here, or click the link in the description, and someone from my team will send you the report. It has all the relevant data points for you to make your own conclusion if Dubai real estate market is a bubble or not. And now let's dig into it. Let's start with defining the bubble signals. Because real estate market bubble is not a new thing. It happened in the US, in Spain, in Ireland, in China, and many other places. And all the real estate bubbles have one or several commonalities. First one is prices being detached from fundamentals. This happens when home prices grow significantly faster than rents, than incomes, and then population. The second indicator is excessive leverage or excessive credit. When the large share of the properties is mortgaged, then the credit risk becomes the real estate market risk. Third is speculative investor activity. Think of crypto. People buying and selling quickly all the time, hoping to make a quick buck. Number 4, yield compression. Prices grow faster than rents grow. Then the yields go down, and it basically means that investments become much less attractive. If this happens, it basically means that the prices are driven by sentiment, not by the income-producing value. And number 5, which is the most interesting in case of Dubai, we'll make a big dive in a couple of minutes, is overbuilding and oversupply. This basically means that developers are selling more units that people actually need. Now let's break down our analysis into two parts. First, fundamentals. Does Dubai real estate market really have economically strong fundamentals? or is the bubble in its essence? Second, supply versus demand. Do we really have a case of too much units to be built? Let's start with fundamentals. And the first thing we should talk about is how strong the UAE economy is. What's really going on here is that GDP is growing year over year, and IMF is predicting that UAE economy is set to grow by 5% in 2025-2026. This is the result of non-oil expansion, and Dubai is set to double its economy by 2033. The growth of economy supports the growth of the real estate market, and the next metric we should assess is the rental rates growth. We're talking about rents, but not the property prices, because the rental rates, they're much harder to affect by speculation. If there is no real demand for these properties, then the rents will not grow. But what happens now is that rents in Dubai are steadily growing. The average year-over-year rental growth was around 20% in 2022 and 2023, and around 10% in 2024 and 2025. And this growth totally makes sense when we assess the key risk and valuation metrics of the Dubai real estate market. First, let's look at price-to-income and price-to-rent ratios. Based on both of them, Dubai ranks pretty great compared to other global cities. The price-to-rent ratio is 13, and it's lower than in other places, and it basically means that you as an investor get more cash on the cash you invested in the property. It means that the prices are definitely not defined by the speculation. There is the real income generation by the properties that is better than in many other places around the world. And the next is price-to-income ratio. By income, we mean the yearly income, the average income in Dubai. In Dubai, the ratio is 7, which is one of the lowest around the world, and it illustrates that for residents, not for overseas investors, for people who are living here, and for those who will be using this property, the prices are normal. And the last important metric I want to talk about is construction to GDP ratio. It's a macro metric that may illustrate that the city is building too much compared to the size of their economy. The normal range is between 5 and 7%. And if we take a look at Dubai in 2007, right before the market crash, their ratio was 12%. So it was pretty high back then, but now it's 6.7%, which is right in the normal range. But let's discuss the issue of overconstruction in more details. Now let's talk about demand and supply balance, and I'm gonna show to you where the main issue is. The main driver of the real estate demand is population growth. People coming to Dubai will be buying units, they'll be renting units, so together with those who are coming here as tourists or as business travelers, they mostly form the demand for real estate. Right now, in 2025, Dubai's population is 4 million people. 5 years ago, in 2020, it was 3.4 million people. So it's roughly a 600,000 population increase in 5 years. Now, when we look at the future supply and we take all the sold residential units, all of them are supposed to be delivered before 2030, so in the coming 5 years, then the total number of units comes to 436,000. Compare 600,000 new residents and 436,000 new units. It's obviously a bubble. This supply is huge compared to the population growth, right? Now let me show you what many people get wrong about it. The 600,000 population growth is a result of a big slowdown that happened after COVID. In 2025, the net population increase, that includes both those who came in Dubai and moved out of Dubai, is 210,000 people. It's in 11 months, so it's gonna be more till the end of the year. But the point is that this number is more than 200,000 per year. And a year ago, it was a bit less. It was around 190,000 people. And even 210,000 population increase is lower than what we had in Dubai before COVID. Now Dubai government forecasts a population of 5 million people by 2030. So it basically means that in 5 years, the number of people living here should grow by 1 million. That's roughly 200,000 per year. Given that in 2025 the net population increase was more than 200,000 people, these numbers make sense. So now it's 1 million people versus 436,000 residential units. That's still too much, right? So now let's take a look at the supply and reveal the main mistakes that global rating agencies make. The first thing you need to know is that in 2025, the total number of delivered units will be around 40,000. At the same time, the projection that Fitch made half a year ago was around 90,000 units, so the actual supply is 2 times lower than their projection. Why? Because of the delays. Normally, only 50% of the planned units get delivered on time. That's why we should take a look at the construction progress in Dubai right now. This pie chart has all the units under construction in Dubai, all 436,000 units, and it shows their construction progress. What is their completion rate? What you can see is that 65% of all the planned units, their completion rate is less than 20%. The vast majority of the project, they're at stage 0. Developers haven't started the construction. Now let's take a look at 2 different sections: 60 to 80 and 80 to 100% completion rate. These 2 categories combined have 13% of the whole supply. It's roughly 55,000 units. So 55,000 units is the maximum that can be completed in 2026. Other units need more than 1 year to be completed. At the same time, Fitch forecasted 120,000 units to be delivered in 2026, so their prediction is more than 2 times higher than the real supply that we can get. If we have to make a guess for the 5-year delivery, then based on this construction progress, around 280,000 units should be delivered in the coming 5 years. This number is not set in stone, many things may change, but what we have now illustrates that first, there is a normal rate of failing to deliver on time, then there is a government regulation, and then there is a shortage of supplies and contractors. Some developers would love to build faster, but they just can't. So most likely, between 2026 and 2030, Dubai will have 1 million new residents and 283,000 new units. This gives us a ratio of 3.5 new residential units per 1 new resident. And to see if it's a good number, we can calculate the same ratio for the previous period, when the market was rapidly growing. Since 2021 to 2025, the population increase was 631,000 people, and the number of new units completed was 172,000, so it's 3.7 units per 1 new residence. Pretty much the same what we're gonna have in the coming 5 years. So the conclusion we can make is that there is no market level oversupply in Dubai. Does it mean that there are no oversupplied segments? No. Does it mean all the properties will perform equally? Also no. Let me show you where the real risk actually is. First, let's take a look at this pie chart. 80% of projects sold in Dubai are priced below 3 million dirhams. What this practically means for you is that if you're invested in an affordable apartment, be ready for a lot of competitors. It doesn't mean that affordable apartments are a no-go by default. What it means is that A. You should choose the most unique properties that will be the most demanded compared to others, and B. You shouldn't expect rapid value growth, the growth faster than the market, unless your unit wasn't priced lower than the market. The second take on the market is villas versus apartments. We'll put some basic growth data on the screen, which basically illustrates that villas are growing 3 times faster than apartments over the last 10 years, and roughly 2 times faster on the resale market over the last year. Villas comprise just 20% of all units sold, and when they're delivered, 2/3 of them don't go to the market, because they're bought by end users. So investing in a good villa sets you into a position when you have not that many competitors. The third take is that different areas have different supply and demand balance. The whole market can be balanced, but you might find imbalance in certain places in Dubai. There are 3 areas in the city that are about to have huge coming supply. 25,000 units in Business Bay versus 50,000 units they have now, 35,000 units in GVC versus 48,000 units that are built now, and 38,000 units in Dubai South versus 10,000 ready units now. I'm not saying that all properties in these areas are awful investments, especially when we talk about Dubai South, but you should be absolutely sure that you're making an informed investment decision if you're choosing one of these 3 areas. And if you want to learn about one more market segment that is undersupplied but very demanded and is growing faster than everything else in Dubai, check out this video.